What's going on? This is David Williams, also known as Diamond Dave. And what we're going to talk about today is how to trade Donald Trump stock, this DJT ticker, I believe, like a pro trader, right? Okay, so let me give you a heads up. I think it's Monday, right? It's Monday. It's 7:13 p.m. on the Eastern Standard Time. What I feel called to do today is have a real trading conversation, right? And that's how I'm going to talk right now. So I'm not going to configure the conversation around I'm just be real with you. I'm just going to have a trading conversation, right? That's what I'm going to do right now because I believe it to be beneficial to people, because the goal of what we're trying to do with the course is get people to kind of understand opportunity and then understand how to engage in opportunity, put themselves in the best position to be successful, because that's what they desire to do. And they also kind of understand the risk that they're taking, right? So what makes this course and what we do in this community a little bit different is we don't necessarily get caught up in a lot of the other stuff that other people get caught up in, right? It's not that I don't care who's president, because I do, but I'm not finna get caught up in it. And my platform is not about getting other people caught up in it and they're not gonna make $3 when it's over with, right? That's just not what we're doing. I'm not into the affinity stuff. When it comes to the markets, I'm not into like a lot of the what I just think is a lot of weird stuff around the markets. It doesn't make anybody money except the content creator. And so that's kind of what we're going to do today, right? So if you're not really into the markets like this is to give you a good bird's eye view of like how to really sit down and really talk to people that actually trade the market. We may not have the biggest platform. I know a guy that trades like real money in real life. He might have 500 subs. We may not have the biggest platform. I definitely don't trade the biggest account. I definitely don't drive as many sales as other people, far as with courses and stuff like that. I haven't made, $1 million off selling courses, but I can trade in real life. And I know how to talk to other traders. I know how to have conversations around it. Even if I don't agree with them, I understand what they're saying because I actually talk to people that can trade, right? And so the goal of what we're doing here is to get people to understand how the markets work so they can engage the markets and benefit from it and go live the life that they want to live because they understand how to engage these markets, right? That's the goal of what we're doing. So let's talk about this Donald Trump trade, right? So again, what we're trying to do with the course and with the community is get you to see opportunity before the rest of the world often sees it. Doesn't mean that you can't piggyback on stuff. Some people are very much trend-based traders, right? So they find the prevailing trend and they ride the trend. The challenge is they got to be legs left on the trend for you to ride it, right? However, really people that are really savvy in the market, they see opportunity before it takes place. And then they have the risk management skills, and they also have the courage to take advantage of the opportunity. So they don't necessarily get paid by talking about it. And there's no wrong with that. A lot of big firms get paid they get paid to advise people on what to do, even though they themselves may not be doing it. Right. So they get paid to see opportunity and advise people on it. And that's how they make their money. So they have to continue to generate ideas. As a trader, I want to really encourage you to do is seeing the opportunity and then understanding how to manage the risk associated with it, and then having the courage to go take the opportunity. Right. And that's really where, in my opinion, you're going to find your most success, also where you're going to build your confidence. Because you have developed a skill that most people would never develop, right? They'll talk about it and they'll definitely talk about it after the fact, but they won't ever really have the courage to sometimes go to try to do it. And it's not that that's an indictment of their character or anything of that nature. It's just not a skill that they have developed, and everybody can develop that skill at different times, right? So if you're in this trading space, it doesn't mean if you haven't developed it right now that you never will develop it. You'll just develop it in your own time. And that's just how this thing works, right? But that's the goal. So we're talking about DJT ticker. So just to give some baseline, this DJT ticker is a shell company, okay? There's nothing inside the company. There's nothing there. There's not even a real business, okay? So they're just a shell company. They were supposed to merge with Truth Social like 2-3 years ago. It's never happened. I don't think it's ever going to happen, but it's just a vehicle to trade. So off the top, it's a vehicle to trade. Now you're going to have a segment of the population. They think Truth Social and Donald Trump's going to change the world and yada, yada, yada. That's cool. They can believe that. And if you really believe it, then buy the stock, right? Buy DJT stock if you really believe that. I don't care either way about how that situation goes because I'm not here for that. I'm here to look at the trade. That's all I care about, right? I don't care about, you know, we gonna take over social media. I don't care about any of that stuff. I don't care about the woke mind. I don't care about any of that stuff, right? Because we just found out that the guy that's telling everybody, you know, he's so much against immigrants, he was an immigrant. But who didn't know that? Because he is an immigrant, right? He's not from over here. He's from somewhere else. So I'm just not into those dynamics of the situation. All I care about is the trade, right? I just don't care about the rest of that stuff. But if that's your thing, I get it. I would tell you to go buy the stock and buy more of the stock and buy as much, go mortgage your house and buy the stock, right? And that's not investment advice. I'm just saying, if you really believe in DJT and True Social, go take a second mortgage on your house and go buy the stock. You're going to make yourself a millionaire. If that's how much you believe in it, right? So I'm not here for the back and forth. I don't care. I'm here for the trade, right? It's a shell company. I don't even know how much money's inside the company. I don't even think there's $1 million in cash inside this deal. They were supposed to merge with True Social years ago. It's never happened. There's been a lot of different things going on around it. I don't even know if they have legitimate earnings reports. Like, it's just a lot going on around this particular deal. But I don't care because it's just a trade, right? That's just what it is. It's just a trade, right? So that's what I want people to understand. I'm looking at this specifically as a trade. The politics behind it, I don't care. Okay, so it's a shell company. Now, here's the deal, right? This thing has been out for a minute. DJT's been out for a minute, right? Let's go ahead and go to the chart real quick. It's been out for a minute. Let me go ahead and get this out of here. Let's go to the chart so we can get some historical context. It's been out for a minute, right? Okay, so I don't know when it came out. It's been out for a minute. That's 2022. Let me go to the 5-year. When did we come out? Okay, so 21. So we got it 21 launching, right? So now we in what, the 3rd year? So it's been out for a minute, right? They never merged with True Social. That's whatever, you know, it's whatever, right? But it's a trade vehicle. Now we know it, we see it's never gotten back to these all-time highs at around $100. It's never gotten back to there, but it's been on a really, really strong tear the past few days, right? Now we can kind of understand why that's the case. We got all the way down to this $10 level, and then people started buying into it really, really aggressively. And the thing about it is not really being shorted that much. So you're going to see on the internet people talking about shorts. It really doesn't have a high short percentage. It does have a legit high short percentage, but it's not like 30 and 40%. That's not what's really going on from my understanding, right? So it's not that shorts are having the cover. It's that people are buying this for whatever reason, right? And I don't care the reason. I'm just here for the trade. Okay, so we know that's the story of it. Now, here's the deal. There's a sentiment around it because of what's going on in politics. So we've seen it sell all the way down to like $10 over the past, how long ago? When did this sell-off start? Right? Sell-off started in July, right? So it sold all the way down to like $10, okay? And then now people are starting to buy into it because we're getting closer to the actual election date, okay? So to me, that's what changed the market sentiment, right? And that's the feeling of the market around this particular ticker. A lot of bandwagon jumpers, a lot of people trying to catch the trade, a lot of FOMO. All of these things can add to the move up, okay? So here's the deal. Here's how I see it as a trader. If he wins, I think it sells off because I think all the enthusiasm will be gone. And I don't think there's anything left for him to do with Trade Social or True Social. I'm sorry. If he wins the presidency, he's going to want to get involved in some other stuff because he's the president now. So he'll leave this little narrative of these, you know, alternative conservative media platforms. He'll leave that alone because now he got bigger fish to fry. He got to run the country. So now he got to worry about trade deals and yada. So he's going to leave that alone. He's going to still have his Twitter account though, but you know, he's going to leave True Social alone, right? So there will be no merger because there'll be nothing there because he's the biggest person on True Social, right? You don't see Candace Owens over there or, you know, none of those that little conservative crew over there. You don't see them over there because there's not enough of an audience for them to keep their situation going, right? Okay, so if he wins, it sells off. If he loses, it goes to zero. Because once Trump loses, his run is over, right? Now, here's how these things work. So y'all know, like in this little media space, it's hard to stay on top forever, right? It just is, even if you try to reinvent yourself. It's just hard. That's how this game works. That's how this media game works. Ain't gonna be but one Beyonce. It's only gonna be one Michael Jackson. Only gonna be one Prince. Like those people that are high profile. I don't mean people that don't have an audience. I mean high profile people. It's hard to stay high profile and stand the test of time, right? You can have your little audience and eat off that real good, but you're not gonna be high profile like that. He's very high profile. If he doesn't win, his high profileness, in my opinion, goes away because he no longer can be the face of the MAGA movement because he can't be president anymore, right? Because he don't win now, that's it. The guy's pushing 80, right? So he going to have to find something else to do. He won't be the face of the MAGA movement anymore because he can't be president. There's a lot of other stuff going on, but I don't want to get into that because I don't want to distract from the trade as to what could happen if he don't get elected, right? There's some situations that could potentially get put on him if he doesn't get elected, which I think is his real justification for running for president. But I don't want to have a political conversation, right? But if he doesn't get elected, I think it's over for him as far as being high profile in the same capacity that it currently is now. He'll still have a movement, but the MAGA movement, him being the face of the MAGA movement to be over, it'll go to somebody else, right? So then what happens to this whole DJT Truth Social deal? That's it for it. Because nobody's going to listen to him the same way they would if they thought it was a potential that he was going to run for president. Like, again, he'll still have an audience, but he won't have the same kind of audience he got now. Because he ran for president, he won. Then he quote unquote lost, however you want to see it. He didn't become the president on his re-election. But because he still had the ability to get back in the mix, it allowed him to keep his momentum, right? So he was able to still keep his movement. Right? He had his motion. Now he running for president now. If he don't win this time, he going to lose his motion at the same regard. So that's going to negatively impact the stock. So again, what's the narrative? We got what? They voting on the 5th, right? Which I believe is a Tuesday. So today is the 29th. So we got 1, 2, 3, 4, 5 more trading days until we actually vote, right? So we got 5 more trading days. We've seen the run up over however extended period of time. We know what's going to happen either way. He wins or loses. What do we think is going to happen to the stock? 1, the stock dumps. 2, the stock sells off, right? If he wins, it's probably more of a gradual sell off. If he loses, it'll probably dump. Okay. So that's how we see it. So what we're currently looking at now is we got maybe 5 more days to run this thing up. What I would look for, and that's why I say this is for pro traders. So this is a very advanced situation. What I normally talk about is directional plays, right? What I call one-legged options trades. When I say one-legged, which means that you only play it for one direction. Now you can sometimes add more contracts to that same strike and expiration. But what I teach for beginners and help them get a foundation is just one-legged trades, right? Why do we do that? Because it helps keep it simple till they learn direction. Because this is a multi-directional play, right? It's not a one-directional play. And what I've learned is that when you got to be worried about Greeks and expiration dates and IV and things of that nature and direction, it can be even more complicated when we add something that's multi-directional because you still got to worry about all the Greeks, right? So you still have all these things that you got to make sure that you understand. Then we add in another direction. This is a multi-directional play. And what I mean by that is that I would have looked to play this in both directions. I would never look to play this in one direction because this is a multi-directional play where instead of me, I can play the run up and I can also play the sell off. And I don't have to wait till it takes place to sell it. You understand what I'm trying to tell you? So this is more of an advanced trading strategy. And you'll see this with a lot of funds where what they'll do is that they'll buy a position long. They'll short that same position. They'll buy calls on that same position, but they'll still hold it long, right? Or you'll have a company to where they'll short equity, but then they'll buy calls to hedge against the short or the equity, right? Or you'll have a situation to where somebody will be long a position and they'll buy puts against their own position. You'll have scenarios where somebody will own the position, they'll be long it, right? And then what they'll do is they'll sell puts against it because they want to get assigned because they believe in the stock. So they'll sell way out of the money puts with the hope that it sells off because they're long that stock. They don't care what happens to it. They want to get assigned, but they also want to collect the premium. These are much more complicated plays. They got a lot more going on, which is why I don't teach it, because I want to always make sure people understand simplicity before we go complex and they understand direction, right? So if they don't understand that, I'm not going to tell them, hey, we're going to own the position long. We want to accumulate more of the position. What we'll do is we will sell out of the money puts to collect the premium and hope we get assigned. A lot of people can't handle that, right? But it's a way in which you get paid to sell puts against your own position, right? And then you use the premium that you sold to buy stock. So essentially, you use the market to finance your next buy. You can do all this stuff and it's legal, but you just got to know what you're doing. You got to know how to compose the trade properly, right? But all of this is available to you in these markets, right? So what we're going to do is this is a multi-directional play, the way I'll be looking at it. So let's say, because today we got 5 days left, we'd be looking to come around, let's say September, October. Let me go to the yearly real quick. Okay, we're on the yearly. So let's say we were coming around early October, right? When it was around, let's say $12 to $16, because we didn't see any selling until we got about right here. Okay. We already know what the scenario is. So already in our head, we're telling ourselves, we want to play the run up, and we also know it's going to sell off in both scenarios. Scenario 1, he wins, it sells off. Scenario 2, he loses, it tanks. So we want to play the run up, and we also want to play the sell off, right? Because I don't want to own this ticker because it's a shell company. So I don't have any desire of owning it, right? So me personally, the way I'm looking at it, I probably don't want to own equity because I got to figure out how to get rid of equity later on, right? I will probably want to play this with options. Now, here's the downside of playing this with options. This is a very volatile ticker. So the IV is extremely high on this ticker. Now, it's even higher now. We're going to kind of look into some of that. But the IV is extremely high on this ticker, right? So the challenge is, can the price movement or the delta compensate for the risk that we're taking? Because a lot of the movement has already been priced in. So we got to believe that the movement is going to go outside of the standard deviation that they're baking into the particular IV forecast, right? But I don't know if I would want to own equity on this, because I do have to sell the equity before they close the door on this ticker, because who wants to own this stock? There's nothing there to own. They don't, DJT doesn't do any real business, right? So what I would look to do is these two particular type of techniques, right? Gave you the trading narrative. So let me ask one question to the audience. When looking at this ticker, DJT, anybody that was looking at it, right? Did you see the volatility before it took place? Right? So one of the most important things about trading, and about especially as options traders, is we're buying volatility to sell it back into the market, right? We want to buy volatility to sell it back into the market. Did you see the volatility before it took place? Because that is sometimes a skill that I want to encourage you to work on, is understanding that as an options trader, you're really a volatility trader. And therefore, what you want to do, we talked about this weekend with the insurance around homes getting flooded out, right? That's a very volatile situation. So then what the insurance company's doing is they're pricing the premiums to compensate for the volatility in that market, right? And they're making you buy that volatility, and it's in your premium. You understand what I'm trying to tell you? So as a trader, what we want to do is that, do we see the volatility before it takes place? Because what I want to help you understand is that this is an example that can be applied into multiple situations. It's not just DJT. But if you understand the example, then you understand how to apply it in multiple situations. So let me give an analogy. If you watching a football game and you see where this team runs this play in this situation, when you play them and you get the same situation and they give you the same formation, you're going to say, well, I have a good idea what they're getting ready to run, because why? Every time they get in this situation, they run the same play, right? And one of the things that you'll see about this market is it's a lot of repeats. it's a similar situation and people do the same thing, and it's a repeat. But a lot of times people have to stick around long enough to see what the repeat is. They don't stay around long enough, right, to actually see it. This type of play I've seen. I did this same type of scenario on a it's an energy ticker that I'm long on now with options called PCG out of California. After they had that fire and they were going through litigation, it was the same type of setup. It was very volatile, and it was played whether it could go up or go down, right? Because of the way the situation was going with that particular. This is like maybe 4 or 5 years ago now. I think this is before the pandemic, right? So it's been a minute. So I did this same type of setup, right? But this is not a setup that I do on a regular basis because I really like directional plays. I don't like a lot of complexity in my trading, but I'm not against it. Everybody got, but I think some people are attracted to complexity just to say they're doing something complex, but it's really not that profitable for them, right? A lot of people like complex stuff, but they just like it because it's complex, but it's really not profitable for them. But I just think it keeps them engaged in what they're doing. So the biggest question is, did you see the volatility before it took place? So we gave the trading narrative. So here's what I would look to do in this scenario, right? I would look to do a straddle, right? One call, one put with the same strike and the same expiration. That's the first thing I would look to do. There's 2 ways I would look to do it. Just do a straddle. I'm going to buy one call and I'm going to buy one put with the same strike and the same expiration date, right? And the goal is to make sure, again, that what I'm paying for one, the premium increase would offset that plus give me profit. Well, why would I believe that? Because of how volatile the play is. See, if the play don't have the volatility, you can't run this because I need to buy 2 contracts and I need what I'm paying for one contract to be offset by the increase in premium on the other contract. But I also got to add a risk premium to it because I'm buying 2 contracts. See what I'm saying? So I need a risk premium in there. So you got to determine what your own risk premium is. So what do I need to get out of this deal to justify me buying the 2 contracts? Because I know I need one contract to cover the cost of the other. And then I need a premium on top of that to justify the risk I'm taking to be in this deal. Right? That's how I will look to play. Right? Next one I will look to do is I will look to do a strangle. That's one call, one put with different strike, but same expiration. Right? So based on this, I may say, hey, let me buy a call that's a little bit out of the money, but I'm going to play the dump on maybe a put strike that may be way, way out of the money because I believe the dump will be so extreme if he loses that that'll be profitable. Right? So I'm playing the next 5 days of continuation. Then I believe the dump will be so great when he loses that it'll cover the cost, right, of paying for that. So I may look at like $2 puts because I believe that if he loses, this thing is just going to really, really sell off, right? So that's the thing is that's what I would do. So Thomas says, why would I not do covered calls? Because I don't want to own the company. I don't want to buy it and then have to sell calls against my position. I don't want to own it. You may say, well, yeah, you can get assigned, but I don't want to own it. I don't want to own this. I just want to trade options. So I get what you're saying. I can do cover calls, but I don't want to own it. Right? I don't want to have to buy because I can buy 100 shares to write one contract. Is that correct? Right? I don't know if I want to do that. You see what I'm saying? Because I know I don't want to own this at all. Now you can say, I see where you're going at it. You can say, hey, buy it, sell a call with the hope that you get assigned. I still get to keep the premium though on what I wrote. So let's say it moves up on the call. Now, problem is we don't have a lot of time now, but let's say hypothetically, let's say we were 2 weeks out from today. Great strategy. We do I buy the equity, write the cover call, sell it to somebody. I get assigned. Yes, I get to keep the premium. Right? That makes sense. You know what I'm saying? But I don't even want to own this. I don't want to own this at all. Because the problem is that if he doesn't get assigned, will I make enough money off the premium? Because we know now premium is not leverage. The leverage is on the option side. If I'm writing the premium, that's just a flat payment, right? Premiums are going to be higher because of the volatility. So I can get a higher premium than normal. But again, I don't want to own it, right? So Pascal says debit or credit spread. So then the question again with Mr. Harley, do I have to own it to do that? Right? Do I have to own it to do a debit or credit spread? That's what I would ask you. Do I have to own it? If I can do it, I own it. I mean, you can do anything naked in the options market. You can write naked all day if you want to. But historically, would I have to own it to do it? I don't want to own the equity. So with a strangle or a straddle, I don't have to own the equity to do that because I have no desire to own this. Because after this plays over, I don't want to have any attachment to it at all. And again, we need to see the volatility before it takes place, right? Waiting for this to happen, we're kind of now getting in late to the deal because we only got 5 more days before the election. We should have had this on the scanner and we should have got alerted around $16 to maybe $20 and seeing, okay, it's going to be a buildup right before the election because where it's at now, I don't know where it's at in the post market. It's already at a resistance level. It could sell off tomorrow, right? So we should have got into this between 16 and 20, had this on the scanner and been looking for this, which is why I always encourage people to have a list of stocks that they're looking at, even if they're not currently trading them. You're just waiting for the situation to take place that puts in a position of where you can think about trading, right? Because you can take a ticker like this, and if you have the capital and have the knowledge, you can make a good amount of money in 3 or 4 weeks that can cover a good amount of time for the year, can cover the rest of your year and just walk away from the trade because that's what a lot of people are doing. They're just going to trade this. This is not a long-term hold for pretty much anybody, right? It's really not a long-term hold. So that's how I would look at it. Strangle or straddle. We want volatility to run strangle and straddle. So for us to run the strangle or straddle, we want volatility. A lot of the other type of spreads, they're not based on volatility, right? They're really based on the stock staying neutral. This is a volatility play, right? So that's the thing. If I start selling calls or selling puts, there is a possibility I can get assigned. Now, I definitely don't want to sell puts because I don't want to get assigned this. I don't want to get assigned this because I don't want to own it, right? So I could generate premium by selling puts, but I don't want to own it at all. So that's what people got to understand is I would be wary of anything in which I would have to own the equity or I would get assigned it, right? I don't want to own anything dealing with this ticker. I just want to generate premium and I want the leverage of the options market, right? But there's nothing wrong with selling premium, but premium is not leveraged. It never is. So a lot of people promote selling premium. I'm not against it as money, but it's not leveraged. And so when we're looking at the chain, it's the leverage on the chain that's going to really generate the money. It's not necessarily the actual selling the premium, right? It's really the leverage, right? So we need volatility to run the strangle and the straddle. Strangle and straddles really run off volatility, right? A lot of the other options, multi-leg plays, they're more neutral plays. They're really not volatility plays, right? You really don't want a lot of extreme movement. With these, I want one side to be so, I want one side of the play to be so extreme because I needed to compensate for the other side of the play, right? With a lot of other plays where, you buy one call and then you sell a call way, way, way out of the money. I mean, that works till you get a movement like you got with Tesla the other day. Then that don't work anymore, right? That's why I tell people about selling premium. Selling premium works until you get an extreme movement in the wrong direction, and then you realize you got to cover. And then what you sold premium on, it gets eaten up by you having to cover the play. But nobody thinks about that, right? They don't think about that part of it, right? But when you look at a movement like what Tesla did, you look at that movement that NVIDIA had, I want to say last year, with that really, really extreme movement, everybody that sold calls on that, they got killed on that play because you sold all that premium way, way out of the money, and you didn't realize how much NVIDIA was going to gap up the next day after earnings because you never can see that coming. So those type of plays, I mean, they work, but people have to really be very meticulous about how they go about it because any strong movement in the direction in which you sold stuff in can put you in a really, really bad position. And you can eat up all your premium, which again is not leverage trying to cover the options contracts that you wrote, right? So that's why you see legit market makers, they don't just write contracts, they also go in the market and accumulate shares, right? Because they have to be delta neutral on their account. So what people got to understand when you get a little bit deeper to the market, and I saw this with Tesla, when you see a lot of calls coming in, what do I know is going to happen next? Now, this is like higher level options understanding. When I see a lot of calls being bought on a ticker, especially in a short amount of time, what do I know is going to happen next? Market makers are going to have to start buying the stock. Because why? They have to be delta neutral on the options that they wrote. They don't have a choice, especially on the call side. So if they sell a lot of calls, they now have to go into the market and buy a lot of the stock, because they can't really operate naked. It's against their risk management profile. They can't sell naked, right? And they have to, because of the risk management profile, they have to make sure that there's a certain ratio between the stock they own and the ratio of options that they wrote. So when they start writing a bunch of options, they eventually have to go in there and buy the stock, which could make the stock move up higher, right? They write more options, and it becomes a feedback mechanism. That's what we call a gamma squeeze. You can gamma squeeze any stock if you got enough money, because the options, the market maker has to, it's like a mandate with a lot of these firms. They have to have a proportion of their, I would call it a ratio of options they wrote, the stocks that they own. So that's something I want people to really understand, is that selling premium is a great way to make money, but you got to really understand what you're doing. I would encourage people to do some type of mathematical modeling to make sure that if the situation runs away from them, they have a way to recover from it, because are they accumulating shares in proportion to the contracts that they wrote into the market? Because if you work for a firm, they're going to make sure you do that. They're not going to just let you write contracts, right? Because you'll blow them out of the water. And then on the downside, you look at like 1987, that crash, that flash crash, that destroyed a lot of people. Because why? If you wrote puts, you're done, right? Same thing with the pandemic. The pandemic destroyed a lot of market makers, right? Because why? The market just kept selling off and selling off and selling off and selling off, and it's not recovering. And people wrote all those puts, right? And the market's not going back up. And then they're buying stuff, trying to push the market back up, but everybody's selling while you're buying. So they're selling until you buying. So now you're really in trouble. So there's, like I said, there's no free lunches in the market, right? There's risk associated with everything else. I would always encourage people to make sure that they manage their risk, right? We need the premium increase of the winning contract to cover the cost of the losing contract we talked about before. That's why this is a volatility play. And we see the volatility here, right? This is the volatility, right? In this short amount of time, it went from $12, $10. We're now at, $47, $50, right? So this is a volatility play. So when I'm looking at strangles or straddles, I'm looking at situations that are very, very volatile. I don't want it. I'm not playing it the trade flat, right? A lot of debit stuff is where I want it to not keep moving. So I buy one and then sell one way out of the money. Now I want this thing to move. I got to compensate for what I'm getting, right? Because you may be able to find a market, and we'll look at that, the chain. You may be able to find a market at $60, $70, but again, there's no leverage there. Now you can do both. You can do a strangle and a straddle. You also can do a debit. You can add as many legs as you want to the as far as the amount of money that you have. But the question is, can you manage all those plays? Because now you got a strangle and a straddle, which is 2 contracts. You got a contract you bought, and then you got another contract that you sold. So can you manage all of those positions at the same time? Now you got to manage 4 positions, right? So these are the things you got to think about as you're starting to add more legs onto your play. Do you have the capacity to manage all those positions? That's a cool word I learned a few weeks ago, the word capacity. I understood it from an economic standpoint. I didn't understand it from like a relationship standpoint. Yeah, do you have the capacity to manage all those plays, right? If we can't see direction, we need to stay away from multi-late plays. So again, if you struggle as a trader with understanding the direction of the market, the direction of the trade, if you still struggle with that, I would encourage you to stay away from multi-late plays, because you just get yourself into a lot of trouble, right? If you're still guessing on direction, or you still waiting for somebody else to tell you what the direction is, I would still stay with just with directional trades. until you get a better understanding of direction. Because with this type of play, it's a multi-direction play. It's forecasting two things happen, and how do I play both sides to benefit? So I'm playing the win and the loss, right? So that's a higher level operation, right? I'm playing the win and the loss. And how can I benefit from him winning and him losing? And I believe that the market will have such an extreme reaction to either scenario, it'll compensate for the risk that I have to take by positioning myself in both situations, right? But if I can't see on a regular vanilla play just direction, I would stay away from this type of stuff because it looks exciting, but it's an easy way to lose a lot of money, right? So it looks exciting because, you know, it's whatever, but it's an easy way to lose a lot of money. So that's what I would do. So that's pretty much going to be it. Not going to be here long. We already been here 40 minutes. Let me see. We got some time. Got a good 10, 15 minutes. If anybody got any questions, anything that they want to discuss, I'll put this in the chat, and then we're going to get out of here. That's there. They played the ad during the live. I might have put ads on, my fault. That might have been my bad. Putting the ad on. Thomas say never go naked is 100 shares per contract. Definitely. Some people, I mean, it's all kind of ways to get money. Some people say, Thomas, to sell naked, but to sell way, 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 way out of the money just to generate premium. I mean, you know, it's a strategy. You know, the problem is if it goes against you, especially on a company that I wouldn't want to own, yeah, that'd be bad. Right? If I sell naked on a company that I know I don't want to own, and then I got to buy it just to cover it, that'd be bad. But sometimes it's what you got to do, you know. So that's in the chart. We'll read some of these comments, man, and we're going to get out of here. If you got any questions, let me know. If you want to come up and talk about anything involving trading, let me know. And we're going to leave out. What's up to Angelo Joseph? What's going on, Miss Phoenix 91? Appreciate you coming through, watching. Y'all remember you trading DJT. Still think it's some trade left. The problem is that it's only 5 days left to the election. And I think that's where it's not a lot of days left on movement, but I definitely do think it's still going to move. But we'll see how it opens tomorrow. I think after the election's over is where you're going to get the real negative reaction to it, though. What's going on with Girls and Pearls? Appreciate you coming through and being a mod. Appreciate it. So what's going on with Thomas? Cedric Webb says bearish on DJT, if anything. Yeah, it's a shell company. Thomas says goes depends if Trump not elected. I agree with you. If he's not elected, this goes to, I think it just fades into nothing. So those 250 puts can be profitable. It's just not an IV, it's just to the ceiling, right? But if somebody was in 250 puts from a while back, just the increase in premium on the IV has made those contracts profitable, right? If they just had deep out of the money, like maybe 2026 250 puts, because like you say, if he doesn't get elected, I think it's over for that company. So PhD program says when buying multi-directional plays, there's a specific percentage of metric where you cut the loss play. So regardless of it being multi-directional or not, anytime I buy options contract, I would always have a criteria of if I lose this a much of premium on the contract, I'm going to exit, right? With this ticker being very, very volatile, I would have a very wide range because it can swing because of the IV being so high. It's a very volatile play, right? But if I was just buying one ticker, I would have an actual formula of if I lose this much, I'm getting ready to cut it before I started adding more complexity of two contracts, right? So that's why I say this is more of a pro level play because it's the volatility is higher than what I would normally even look at. But I think because of the scenario around it, it can still move. I really do. So we talked about covered calls. We talked about debit and credit spreads. So John Cox says 49.55 post market. Yeah, still moving up. Let's see how it opens up tomorrow. What's the likelihood of a circuit breaker? I don't know. I don't know. I don't know the dollar move in a certain amount of time that trips the circuit. I'm not sure. You normally see more of that going down than going up. Okay, it looks like it's going to be it because the last comment is where they played an ad. So that looks like that's going to be it. So I appreciate everybody for coming through. Want to really encourage you to make sure that you manage your risk. And want to try to encourage you to start seeing the play. We'll kind of talk about this last point. Seeing the volatility before it takes place, right? Try to observe situations that you believe are going to move before the rest of the market kind of jumps on it. There's nothing wrong with being a trend-based trader. You can make a lot of money doing that. However, a lot of times the profitability is in not being the bandwagon jumper, right? So I would have waited for some type of confirmation on candles before I got into this play, but I wouldn't be trying to get in after, 2 weeks of it running. And now I want to show up, right? So that's why with this scenario, the question is, would we believe this was going to happen 90 days ago? And if we believe that 90 days ago it was going to happen, we would have it on scanners, right? Or have some type of alert on our phone. And as people started to get into a position, then we say, okay, it's something that we want to consider because we've already considered this may be a great opportunity to generate some alpha on our account, right? Because market sentiment has changed now for whatever reason, because it's getting ready to have election day. It's going to be the same company, but for whatever reason, people want to file into the company, right? And it becomes a feedback mechanism where people buying it start to drive more people to buy it because everybody's trying to figure out an easy way to make money. So that's going to be it. Hope you got some value from it. If you got any questions, let me know. David W. Williams, also known as Diamond Dave. I'll talk to you later.